Good day, Market Chameleons, and everyone joining. Thanks for coming by to the Market Chameleon tutorial series. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show and webinar, like all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. One last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. How you doing, D?
Good morning, Will. How are you?
Good. So today we're going to talk about how to visualize any option strategy with a payout diagram, correct?
Yeah, and let me hold on a second. Well, it looks a little bit different right now. I'm trying to figure out how to share my screen here.
No worries. With that, we lost Dimitri. All right, let's look to get him back. Welcome everyone this morning. Good to see you, Mike. And we got Dimitri back. Let me add him to the stage.
Yeah,
There?
I'm just trying to figure out how to. This looks different today. Okay, here we go.
You may have upgraded the software overnight. That sometimes happens.
Okay. There you go. Can you see my screen here?
Yeah, let me add it to the stage right now. There we go.
All right. Good morning, everyone. Um, and yeah, let's go over a option payout diagram, an option strategy payout diagram. I'm going to use an example here in our tutorial. So I'll type in SPY so we could see how to bring it up. You come to the SPY main summary page, and on the left-hand side, under options, click on option chain. And this allows you to create a strategy from the existing available options by clicking on them, creating a strategy, and then running a payout diagram. And I'm going to just close this or minimize the menu to expand our screen. And the idea here is to be able to create an option strategy and visualize your risk or know your risk ahead of time. So a lot of people, unfortunately, when you talk about risk management in their mind, they think of management as a stop loss order, but that's not really managing risk. That's just liquidating risk because you lost you lost money on it. But managing risk is different than just blowing out your risk because it went against you. Because that's what risk does. It goes against you. Imagine if you invested in a piece of real estate, right? You took the piece of real estate and you invested it because you had a certain outlook on it, and every time the real estate market dipped, you go out and just blow it out at the market. Well, that wouldn't make sense. Or you didn't manage your risk correctly. Let's say, you decided, well, I'm not going to buy fire insurance, and then the building catches on fire. Then afterwards, you just go and dump it on the market and sell it at market prices after it burned down. So so that's not managing risk if all you're doing is b- blown out your position at the market because you didn't actually manage your risk. You just incurred a loss and then just dumped it. So the idea behind risk management is known ahead of time or estimating ahead of time your risk and what's acceptable, how you're going to manage it. Because really, if you think of it as if you bought a piece of real estate and the market dipped 10%, well, if nothing really changed fundamentally, your outlook is the same. Wouldn't you want to have room to buy more? Wouldn't it make sense then? Well, at this stage, if my outlook didn't change and nothing, just the dynamics of the market, supply and demand changed at that moment, it could offer even another better opportunity even. So when in options, we have to have a way to also estimate our risks, and even shock them to see, well, what if this happens or that happens. um, let's use a payout diagram in our example, and we'll create a strategy. I'm going to come out here. We have all these different expirations available for trading in SPY. So let's just go out to, let's say, July 18th. I'm going to click on that. This will bring up the July 18th option chain expiration. And we'll create a strategy. You could do one leg, but you could do multiple legs. The more legs in your strategy, the harder it is to visualize your potential risks. Um, so let's say we did something like, let's do a call spread, out of the money call spread. So let's say we sold an out of the money call spread. I'll start out here. This is strikes 1%, um, out of the money, 630 strike. So let's say we sold this call here. And then let's say we did, maybe instead of a calls, maybe instead of a call spread, let's do a ratio spread. Let's say we decide that if it goes up, yeah, maybe 2% to the 636, we buy that back. All right, so now we have selling the 630 call, buying the 636 call. That's just a call spread. But let's say we wanted to do it in a ratio. So let's add here 3 contracts. So now we did a 1 by 3, 630, 636, 1 by 3 call spread. And let's add a couple more. In addition to it, let's say we are feeling maybe a little bit bearish and do a put spread. So let's say we buy the 618 put, right? So now I added a put if it goes down, but let's do a ratios here as well. And let's say in the next, 7 calendar days, five trading days, 7 calendar days, we don't think, it's going to go down by more than 3%. Okay, so maybe it's going to go down, sell off a little bit, profit taking, but our outlook is around the 3% level. So let's say the 605, we're willing to sell those puts to help finance some of the other strategies. And let's do that one also in a ratio. Let's do like a 3. Okay, and let's run this strategy. And now we get this weird payout diagram at expiration. You see, so we kind of see where it does well in the green, where it loses at expiration. Um, let's expand on it. I'm going to come over here in the summary. Let's click on payout diagram. And here we have what it looks kind of like at expiration, right? So this is the payout diagram at expiration. In green, it's profitable. Here, it's not. This is a loss. You could see here as it's going down, seems like, there's at that point, you're just losing as it goes lower and lower. But if it goes up past a certain point, remember we did a 1 by 3. So if you're selling 1 call, but you have 3 calls, eventually you're stopped out, and those 2 extra calls will be in the money. But we did the opposite on this side. We sold 3 puts. So as it falls below that strike, well, you got these 2 extra puts that you sold, that are unhedged, and they're going to be going in the money more and more, and you're short those. So this is kind of like, visually we see, well, in this area we lose, but kind of limited. So we don't want it to stay in this area. We want it to go up, or if it goes down, we want it to stay in this area. And this gives us a quick just visual to see if that risk is acceptable, and does it line up with my particular outlook. So in this situation, my particular outlook would be, well, if we go up, if we're going to go up, we're going to go, off to the races up here. We're not going to sit around this area. And if we go down, we're going to go down, but not a lot. It has to stay in that area. Now, let's suppose we want to compare this payout diagram at expiration to a diagram that we're estimating prior to expiration. What if we want to know that we're willing to hold this position for maybe a day or two, see how things work out, and see where that position could be based on certain outlooks. So let's now compare these inputs instead of going all the way to expiration July 18th. Let's see what this would look like July 15th. Okay, so I'm going to just take 3 days out and see what this payout diagram looks like on July 15th if the implied volatilities all stayed the same. I'll run that diagram. So now I get this blue line, and this blue line is drawn an estimated payout based on where we think, where these options using the option pricing model would be given the decay, right? So as you get closer to expiration, options decay. So this is looking at same implied volatility, but the options decay, and where does that P&L look like as the stock moves around, right? So this is this down here are shown different stock price moves, right? So where on this going to the left, stock price is moving down, going to the right, stock price is moving up. What if we gave it, in addition, an implied volatility change, right? What if we decided, okay, we see what it's like with the decay. What if we moved around the implied volatilities? Okay, the implied volatilities went up, went down, and we could do that for each leg, right? So we see what the implied vols are right now. What if we moved it for each leg? What if we, decided to, give this one 11? So we added one vol click. What if we decided that this one will move up to, let's say, 10? So we raised that by 0.7. Let's say we raise this one to 14. And let's say we raise this one to 17. Okay, so we added implied volatility, different amounts. We're going to run that diagram. So now we kind of see that blue line shifted a little bit more based on that implied volatility change. So in this situation, we're kind of testing out what my position would look like at different price levels, also with time decay or implied volatility changes. And it allows me to make a more informed decision, ahead of time. Is this a position that uh, you know aligns with my particular outlook, or is the potential payout versus the risk acceptable, and how would I manage this position as the stock moves around? So, well, I'm going to stop right there because I covered that tool. I think all the
Yeah, that was a
parameters.
great explanation of the use of the tool, D. Great job as always, my friend. Thanks for starting off the week with this great tutorial. You have a great day, my friend.
Right. Thanks everyone for joining. Stay safe out there. Have a great trading day, and we hope to see you tomorrow.
All right, we'll see you tomorrow, D. Bye. All right, everyone. Thanks for joining at the Market Chameleon pre-market show. My face again is a half face. I'm sorry it keeps getting cut off. I guess it's the light behind me. Remember to like and follow us on all the social platforms. Thumbs up, always appreciated for those on YouTube. Everyone have a safe trading day, and we will see you tomorrow.